This episode of the Old Dogs REI Network is brought to you by Mino Studio. Welcome to the Old Dogs REI Network, where cash flow is king. Real estate investing, the means, so you can enjoy your retirement dreams. This is the show where we cut right to the chase. No sales pitch, no long monologues, just simple how-to real estate investing advice, so you can earn the passive income you need to enjoy your retirement today. And now, your host and chief old dog, Bill Manassero.
Hello, old dogs, and welcome to
Fun Facts Friday.
This is our once a week, only on Friday show, where we have special episodes not featuring guests, where I will share tricks, tips, terminology, and techniques that will help skyrocket you to real estate investing success. Today's topic is most common real estate investing mistakes. Before we get started, just want to touch base with you guys and just make sure you're doing okay. I know that there's just a lot of crazy stuff going on coming up to the elections here, and wanted to just make sure your health is good and your family's doing well, and that hopefully your real estate investing is going great too. I know a lot of folks that are doing good. Well, let's jump into our tip of the week. Okay, and this is protect yourself. If you're thinking about investing in one or multiple properties, you really should consider using an LLC to purchase them. Now, sometimes people can have an LLC for each property. Sometimes you might have an LLC for that particular state or city you're in, and you have other properties going into that. But you get your ultimate protection by having an LLC for that one individual property. And then there's a lot of strategies involved in that too. So if you invest in multiple states, you might even consider setting up an LLC in Wyoming or Nevada or Delaware, where you can have an anonymous LLC, which will allow you to put your other LLCs underneath that one, and it gives you added protection. Again, LLCs are things to protect you. Primarily, it's risk management. If anything should happen on any of these properties, you are not held personally responsible. Also, an LLC can protect your retirement fund should something occur on the property. It can also give you a checkbook control, which is really nice if you have a solo 401k or maybe a self-directed IRA that has checkbook control. It just gives you quicker access to your funds, and you don't have to go through an approval process like you might have to do with other types of self-directed. So protect yourself. Good idea to get an LLC. Easy to do. You can go to an attorney and have that done, or you can go through LegalZoom, which is a real easy way to do that as well. So that's today's tip. Protect yourself. Well, let's move into our topic, most common real estate investing mistakes. Now, one of the reasons we have this show is to be able to profile. Not only do I share my own mistakes that I've made in real estate investing, but we have guests on too that'll share common mistakes and things that have happened to them. The more you can collect that information, the more likely you are to avoid making the same mistakes that others have made. So I think that's why this is a good topic that you should zero in on, so you can look at ways that to prevent you making those same mistakes. Real estate investing can be very profitable and worthwhile to build cash flow, obtain a great return on investment, and to build a legacy for your children and your children's children. However, being wise and understanding that you can achieve significant success by avoiding these mistakes is really critical. So let's jump into these. I've got, I think, about 12 different key mistakes that are pretty common. Let's go. Mistake 1, spending thousands of dollars buying books, tapes, and attending seminars, and then putting all that information on a bookshelf and never looking at it again. Well, I'm constantly amazed at the number of would-be investors who've spent a bundle of money attending seminars, getting an education, and then never using it to start their investment program. Not only is it a waste of thousands of dollars, but it could be the biggest financial mistake you can make. Real estate is a great investment, and you want to make sure that if you do dig into it, boom, you got to take that step, which sometimes is the hardest part for people, that first step, that first property, or maybe your first passive investment. But either way, once you've got that education, use it because the returns are excellent. Okay, mistake number 2, failure to learn the basics of real estate investing. The other extreme to number 1 is that potential investors who realize real estate is the best way to accumulate wealth and venture into the purchase of properties without knowing the basics of real estate investing. And those investors are certain to get into financial trouble. And there are some real key basics that you can get. There's some good podcasts that we've done that kind of give you the foundation of what you should know going into a property, how to analyze properties, how to analyze a market, how to choose the type of investment that would be best for you. But a lot of that is basic stuff. And there's some great books. If you go to our resources section on the Old Dogs website, we have our top 20 real estate investing books. And those books are filled with all kinds of basic information as well as advanced information. Okay, mistake number 3, fear of making a huge financial mistake. We all fear making mistakes, especially a large financial one, especially later in life as we are advancing or in years or retired or approaching retirement. If you follow the advice of number 2 above, you won't have to worry about making a financial mistake. The idea is to get that foundation. You're never going to learn everything, and mistakes are part of the deal, but you can avoid a lot of that by just getting that good, solid foundation in place, that education. Number 4, not looking at more properties. Okay, and that's one that happens a lot. Some people are so excited about investing that they just kind of grab the first one that comes along. So don't fall in love with the first property you look at. Lots of investors buy properties because they look nice, or maybe they just don't want to take the time to to see what else is out there, or to dig a little deeper into that property. But part of sound real estate investing is in giving yourself a choice so you can select the best property you can find. Mistake number 5, a better deal may be around the corner syndrome. This is the opposite of the mistake we just mentioned. This investor never starts his or her real estate investing program because they always hope a better deal may be out there. It's somewhere it's the sort of a wait and see, and you never really get on the first base. So I think that can be an issue too, is you need to find that best deal you can find, but don't there's no perfect property, believe me. Mistake number 6, thinking that real estate investing is strictly a complicated game that only the wealthy can play. Now, first of all, real estate investing isn't complicated if you learn how to get those basics down. Did you know that even professional investors use a simple 9-step process to analyze the financial feasibility of an investment property? I even have like a quick little checklist. It's called a 3-minute rental property analyzer that's free on our website that you guys can go to and get anytime. And that helps you to look at some of the key areas. But just learning simple, there's a 9-step analyzing process that you can go through yourself that's super easy. And the first step is you look at the scheduled gross income. So that's income if it's 100% leased, for example. And then you minus the allowance for vacancies, then the operating income before expenses and the marketing payments. That gives you that income before expense and marketing payments, less your operating expenses, which are taxes, insurance, utilities, repairs, and maintenance. And number 5, that'll equal your operating income. Okay, income before your mortgage payments. Number 6, you minus the mortgage payments, okay? And then number 7, that would equal your cash flow. And we're all about cash flow here. We say cash flow is king, and that's really key to know how to get to cash flow. And then number 8 is the mortgage principal payment. You add that mortgage principal payment, and number 9 will equal your total return. So getting an idea of calculating cash flow, cash on cash return, return on investment, those are some of the basics. And they're pretty easy to do. These are easy calculations. We're just talking, a little bit of multiplication, division, and, subtracting. I mean, that's it, adding and subtracting. It's pretty simple, but learn them and know them. And as you start to get in deeper into properties, we have more extensive analyzers that you can get, and that will really take you through all the variables, IRR, and various other factors that might be a little bit more involved. But getting the basics down is not difficult. Number 7. Falling in love with the property. Once you've got your feet wet and become a real estate investor, you'll wonder why you waited so long to begin. Now you'll face another problem, falling in love with your property. They've seen how well it is doing. Typical investor, cash flow has been going up each year, and they've fallen in love with their tenants, not literally, of course, but 2 big mistakes are made here. First, never fool yourself into thinking your property is doing well enough to sell or trade up because your cash flow is considerably higher than when you purchase the property. I mean, that's going to happen in any case. The second part of that is mistake number 7, falling in love with your property, is getting so friendly with your tenants that you fail to maintain rental standards based on what the market will bear. This greatly hinders your growth potential. So, properties and leverage are a part of the game as you're building your portfolio, as you're building up to the properties that will sustain you through retirement and hopefully be something that's valuable enough that your family will benefit later on after you go. So mistake number 8, failure to effectively plan your financial goals. Before you purchase that first property, which of course you have financially analyzed, right? Determine what you expect from your investments, your financial goals, basically. It is known as the time versus money concept. And the more you have of one, the less you need of the other in order to reach your financial goals. And sometimes this, people get hung up on this. You get maybe you're investing in Class C. If you're investing in Class C, you can get bigger returns, but there's going to be more time required of you. And as you go into Bs and I wouldn't recommend going into A's, but, Class B's are pretty solid. They should require less time. And, the return may be a little bit less, but overall, I think you're going to be making more because of the lack of headaches and the other financial things that you're going to get involved with Class C properties. Let's look at mistake number 9, trying to purchase properties that the seller isn't motivated to sell. Now, buying off-market properties is a wise strategy, and I really recommend it, especially in uncertain economies. When you're buying off-market properties, you'll have that built-in profits. In other words, you make money the day you buy it. I mean, you've already made money. Boom. However, I've also seen potential buyers continually try to purchase investment properties that owners are just not interested in selling. So spend a lot of time, or should I say even waste a lot of time, chasing after something that it just isn't going to sell. They're just not interested. And this includes, property owners with the attitude that, sure, it's for sale, for the right price. Unfortunately, for a price part usually means it will make no financial sense for you as a buyer. So you may think it's a great property and, all right, so I have to pay a little bit more for it. I've seen this happen with single family homes. I've seen this with massive apartment buildings where people end up paying more than the asking price or more than it's really worth, just to get that property. And it's it's not a wise thing to do. If it doesn't make financial sense, you shouldn't be buying it. Mistake number 10, believing you can get rich overnight. Okay, now this one is perpetuated by a lot of gurus out there, unfortunately, that really say, hey, there's no effort to building up a giant portfolio with very little effort and very little time and very little money. Well, it's just not true. So, getting rich overnight won't happen, regardless of what the top experts will tell you. It takes time, hard work, and knowledge of real estate investing to do it with maximum return. The important thing to remember is that you can do it. You can join the millions of other investors who've generated sizable incomes by investing in real estate. But you have to be patient and prudent, and you have to take your bumps and grinds in that process as well. You learn as you go along, but you will do well. But be persistent. Don't give up, okay? Mistake number 11, not financially analyzing a potential investment property. We talked about this briefly here. This is the most serious mistake an investor or potential maker can make. I've seen a few pros in the business rely on a worthy and inaccurate rule of thumb to make a huge financial purchase decision with total disregard for how well that property will perform. It's all in the numbers. It really is. And learning the numbers, you don't have to be a rocket scientist or a math whiz. You just have to get the basic numbers down. But they gotta make sense, and you can't vary from that. If the numbers don't make sense, you don't go to don't buy that property. Make sure you have carefully collected the right data, that you are allowing for all contingencies, and that the numbers work before you buy. Yes, there is one more major mistake investors make, okay, and this is mistake number 12, thinking it is important to pay off your mortgage as soon as you can because mortgages are a necessary evil. First of all, as a real estate investor, mortgages are an important part of financial success and not a necessary evil. You must learn why this is true. You must learn how, in the right situation, a second or third mortgage can be a nice thing. Secondly, mortgages are one of the keys to generating wealth in real estate. You must learn how to use financing as one of the keys to building a profitable real estate portfolio without concern for it being risky. And finally, of course, there's the benefits of having the mortgage interest tax deduction as well, which can really help you, especially as you're building your portfolio. Now, granted, I understand later in life here, the last thing we want is more debt. But to get to the point where you have these sustaining properties that you have, yes, I would recommend paying those down. But you got to get to that point first. You get to that point, then all you're going to do is increase your cash flow as you start paying down and accelerating the mortgage pay down. But while you're doing it, while you're buying these properties, it's really tough to grow and to grow quickly without leveraging. And leveraging requires mortgages and refis and all the other things equated with that. So that is the 12 common mistakes that we all get involved with. Now, as an old dog, I want to avoid as many mistakes as possible. As a young pup, those of you out there listening that are not in the old dog status, you can afford to make a few mistakes. You've got plenty of time to recover from it. But later in life, you want to limit your risks and you want solid, dependable returns. You want to avoid those big mistakes. So hopefully today's podcast will help you to avoid those problems. Of course, we're all going to have problems with mistakes, but hopefully you'll make a few less after listening to this, and you can just enjoy the benefits of your great investments. Well, that's it for today. Please note, Old Dog listeners, everything presented here today can be accessed in our show notes on the Old Dogs website at olddogsreinetwork.com/blog. And you're going to look for the episode entitled Most Common Real Estate Investing Mistakes. So until next time, remember, cash flow is king and real estate investing the means. Until next time, keep moving forward and may God bless.
Thank you very much for visiting the Old Dogs REI Network. We would greatly appreciate if you would stop by iTunes and let us know what you think of the show. We would love if you could subscribe to the podcast, give us a 5-star rating, and write a review. The more ratings and reviews we receive, the more visible the podcast will be to others. Thank you.